what I find particularly interesting, and this is why I'm just so interested in the crash course and what you've been saying, is that since you started doing the crash course, the acceleration in the production of money and credit has increased almost exponentially as far as I can see. And I can't see any sign of that stopping. What's your take on that?
I think that if and when the exponential increase in money and its flip side, debt, because money is created from debt, when that finally stops and breaks, we're going to find that the whole system no longer works. We'll discover that all of the credit outstanding, forget about future credit, like we want to continue to exponentially increase at 6-8% a year or something like that. Just the outstanding debt won't be serviceable at that point in time. And that's what we're already seeing when we look at the weaker economies that exist out there, the weaker sovereign states. We see that mathematically it just doesn't work anymore. And people say, well, how could it ever have worked?
Absolutely.
Right?
Everybody's trying to borrow at the same time. And so you've got this sort of clash, one-sided. You know, we're all borrowers, we're not lenders. I'm talking about governments, of course. Right. The only possible government, I suppose, is China. But I mean, the reality is that China is sort of tied in with the dollar to a large extent. It's trying to escape. It can't escape. It's not going to change anything, as far as I can see. And we have crowding out in terms of government bonds being issued at a greater and greater pace. And to my mind, and I'd be interested in your thoughts on this, to my mind, the Fed, by keeping interest rates low and by doing quantitative easing and whatever other mechanisms come to hand, the real reason for them doing this, they say, is to try and ensure that the economy grows and, you know, they sort of keep within their mandates and all the rest of it. But surely the real reason has got to be, they've got a twofold problem. One is to keep the banking system going, and they don't want the contraction of bank credit, which I think banks would naturally do left to their own devices. They don't want that to get out of control. And I think the other thing is that there is no way that the US government can borrow the amounts that it requires to sustain that deficit without money being printed. And that surely is an accelerating factor, or is it not?
Well, it's just, you know, starting with the deficit to begin with, you know, it's an amazing feature of government that when they ratchet up spending, it becomes a very sticky phenomenon. It's almost impossible politically to get it to go back down. We see the super committee right now meeting in Washington, D.C., Democrats, Republicans, trying to figure out how they can shave, you know, just literally a few $100 billion off of a deficit that's now 1.5 trillion.
It's absolutely nothing.
It's absolutely nothing. It's perhaps a fifth of the total run-up in new spending. So they ran all this new spending up and now can't figure out how to undo it. And that's a very predictable dynamic. And that's not, you know, just endemic to the U.S. Any government seems to have that same sort of difficulty.
Is that something that's likely to change after the election? I mean, is it just an electoral phenomenon?
No, it's very structural. The mandatory component of this, by which I mean, you know, mandatory in U.S. terms, so that's all the entitlement programs plus, which is Medicare, Medicaid, Social Security, defense spending, plus interest on the debt. Those alone account for about 76% of the pie. And it's really almost impossible to cut defense spending, which is why I tucked that in there. But maybe there's a little wiggle room in there.
And of course, a lot of that's been off balance sheet, hasn't it?
Absolutely.
I don't know whether that's coming on balance sheet or
not anytime soon. No, that won't be happening.
It's very often not appreciated.
Right. So here we have this $3.5 trillion budget that has to be funded somehow. It would require a doubling of taxes to support it, you know, by normal means, and that's politically, I think, undoable. And if they cut it, the economy falls apart. You know, right now the story is the United States economy is eking out a 2% sort of a growth rate, but that's with nearly 10% of GDP deficit spending by the federal government, some more percent deficit spending by state governments. You take those two out and say live within your means, and you're facing a really serious contraction in the economy, which then calls the entire question or edifice of debt itself into question. And so this is something that really is unsolvable if you look at it from normal mechanisms. We're going to cut spending, raise taxes. So third option, we're going to have to print in to cover that up. And I think that if there is a strategy, it's this. We're going to print and we're going to hope that somehow the economy picks up and keeps going like it always has done. And this is where we pull the energy part into the story, because it is my contention, my thesis, that we do not have the high quality, cheap energy sources that are required for that old magic to work itself one more time. When we look at any of the new finds that are out there, the deep water finds, the Orinoco Belt in Venezuela, the tar sands, any of these things, all we find is expensive, expensive, expensive. Capital costs, however we want to measure it in dollar terms or Canadian dollars, doesn't matter. It looks expensive, but what really matters is that the net energy we're getting back from those investments is less than it used to be. And it's net energy that funds this whole thing that we've called our economy.
So we have a situation now where we're coming into the Northern Hemisphere winter, when demand for heating oil and so on and so forth tends to rise. You've just described peak oil. I don't doubt that's right. Not only that, but there is some evidence that OPEC members have been bulling up their figures over the years, really, because that's the way the quotas work. Mm-hmm. So are we likely to have significant price rises in energy in the coming months, given that demand is going to increase because of the northern winter, and at the same time we've had this enormous printing of money by the Fed? Isn't that going to drive prices up this winter?
It absolutely will. The only thing that could derail that story is if we have another sudden sort of collapse in global demand due to some big recession or something more that comes along.
But hold on, if you look at the unemployment numbers in the States, we are already in a depression. I'm putting to one side what the economists say is actually happening with GDP. But just on that side alone, it looks to me like we are already in quite significant trouble.
Well, so the story is this. The OECD countries have actually trimmed their oil consumption back considerably since 2008. And the world, for whatever reason, hasn't managed to produce more. So who ate up the difference? Well, that was China and India for the most part. So just those two countries account for most of that. So this is a story of we're producing this much oil in 2005. Somehow we're still producing the same amount in 2008. And we're still producing roughly the same amount today. OECD went down, China went up. So when I say demand destruction, it would require something like China really falling off the rails here. We're seeing some early signs of manufacturing weakness. Their housing bubble maybe is in peril. That would be the only thing that could really shift this story for me. Otherwise, what we're facing at this point is that oil is a very inelastic substance. We demand it whether times are tight or not, whether it's what the prices are. OECD, United States demand is down almost 13% from its peak. My goodness, that should have collapsed the price of oil. And it's, last I checked, WTIC was at 98, and Brent was over 110.
Persistently strong.
Very strong. So that's consistent with this idea that even with relatively weak economic circumstances, for whatever reason, oil is still very well bid. And so I would expect oil prices to rise on that basis, regardless of there might be this little hiccup because something might happen. My personal crossover date for when the world suddenly world stage headline says, oh, peak oil's real, is somewhere around 2013 or 14. That's what all the data is projecting at this point in time.
That's interesting.
When that comes, what we don't care about is how many millions of barrels get pulled out every day. We care about how many get pulled out and aren't consumed inside those countries and are available to the export markets. That's only 35 million barrels a day. All it would take is one producer, say Norway, to say, we'd rather leave this for our future generations. We're trimming our exports. And the whole market goes haywire at that point.